purpose of this presentation here is to give you an overview of kind of what we do in these executive programs. I'm combining some materials that we have both in the private equity class but also in the mergers and acquisitions senior executive class. And I encourage you to be open and ask questions and have a discussion. This is how we run our classes here. They're very interactive. And the way we view education here is it's kind of a multi-dimensional exercise where participants learn from us, from instructors, but also we learn from participants, and participants learn from each other and their experience. So that's part of the, if you want, the experience of education here at London Business School. This is just a very basic outline of my presentation. So I would like to give you a bit of background about the M&A market, about the private equity investment model, if you are not familiar with the private equity investment model, and give you some work that I have done with my colleagues here at London Business School, because here at London Business School is not just about imparting information that we learn from outside. We actually create knowledge ourselves. So we do our own research. We try to understand the markets, try to understand, in my case, M&A markets and the private equity market. And I'll end up with some interpretation of what I think explains the results that I will be showing you. I'll keep it very light. I'll have a lot of graphs, but feel free to ask me any questions you have. So let me just start with the basics, a bit of background. And I wanted to start with this graph. It's a very interesting graph, and I don't know how many of you are aware of this. But over the last, as you can see, from 2005, so from 1995 to 2015, so we have about 20 years of data now. The number of publicly listed companies on the US equity stock exchanges has dropped in half. This is a very big result. It's basically, and we can talk about it for a moment, but it's showing you that the number of publicly listed companies has been dropping dramatically over time, right? The market capitalization overall, if you look at the Standard & Poor's 500 index, or if you look at the NASDAQ index, or whatever index you want to see, has been increasing over time. But overall, the number of companies that are listed on the stock exchanges has been decreasing. Why do you think this is the case? Could be that there's a lot of private equity capital out there, and because you have that capital available, a lot of companies decide not to go public. They prefer to remain private. And there are some advantages to being private. We can discuss about that later. Other explanations?
Consolidation.
Consolidations. It could be an M&A game where a lot of very large companies are buying the smaller companies that are also listed on the stock exchange. And as a result, you have fewer companies listed, but obviously the market capitalization is the same. Or you might have very large companies that acquire private companies before they get listed on an exchange. That happens as well. So these are kind of the main two reasons why we see this significant drop in the number of publicly listed companies. Yeah? So here is some data that I crunched using Thomson One, which is a very large provider of M&A, mergers and acquisitions data. And it shows you the extent of mergers and acquisitions, the transactions, the deal flow that you see in the market over time. So as you can see that you kind of pick up the tops of the cycles. So we have 2000, there was a very, very high cycle with the telecom industry. Sorry, my phone is on. And then we have the very recent peak before the credit crisis. And then we see yet another peak these days, right? We can see that the numbers are quite high. So numbers that you see here are in $1 trillion. But that gives you some idea about how active the M&A market is and how these potential transactions, how these transactions contribute to the consolidation of the publicly listed, the number of publicly listed companies out there. Yeah. Now, if you look at this data more carefully, you will see that on average about 25 to 30%, depending on the year, and sometimes even 40% if you look back in 2007. So anywhere between 25 and 30% of the M&A market is actually dominated by private equity funds. I didn't yet explain what a private equity fund is, but I will do so in a minute. But just again, give you some idea that the M&A market is driven by two types of players. You have the very large corporates, Microsofts of the world, Amazons of the world, GEs of the world, that buy companies, but you also have a lot of private equity funds whose main purpose is, the reason why they exist is to buy and sell companies. We'll talk about that in a minute. Yeah? And they take about 30% of the M&A market out there. Now, this is the capital that is under the management of private equity funds. And this is the latest data that I have available from Precone, which is the main source of data for private equity. As you can see, since 2000, when private equity funds had under management about close to $600 billion. So since 2000, 16 years later, the money under management is close to 2.6 trillion, right? So between 600 and 2.6 trillion, we are talking about a market that went up almost 5 times. So the amount of capital that is under the management of private equity funds over the last 15 years went up 5 times. It's a significant growth, very, very significant growth. And what you see here, kind of the data is split in 2 parts. You have assets under management that currently are sitting on these private equity funds' balance sheets, so investments they have already made in companies. But you also have this darker area, which is what they call dry capital. This is capital that has been committed to the private equity funds by investors, but not yet invested. And it is expected to be invested over the next 3-4 years. So you can see that at the moment, the amount of dry capital, which is capital that the funds have available, but they didn't invest yet, is reaching now about 36% of the overall capital allocated to the private equity funds.
Already committed for purchases, or just there waiting for an opportunity?
Waiting for an opportunity. So typically investors in private equity funds, which are typically pension funds, sovereign wealth funds, very long-term investors, commit the capital to the funds. Then funds having these commitments, they go out there and they try to find targets. And it takes 3-4 years to find these targets. Over this 3-4 year period, the capital committed to the fund but not invested yet is called dry powder. And it's interesting because I was at a conference this week and then another one last week in private equity, and people are very worried about the amount of capital that is sitting out there uninvested at a time when the M&A market is actually close to its peak, right? So you see there's a lot of capital out there, there's a lot of liquidity in the market, and you wonder whether the private equity funds will be able to allocate over the next 3-4 years close to $870 billion to buy companies. Yeah, and this is the global market, by the way. So 2.6 trillion, this is how much is under management at the moment in private equity. Do you think that 2.6 trillion is a lot of money, or maybe not? What is your view on this? Seems like a large number, right? What's your take on this number? Do you think the industry will keep growing like this? See, if you invest in a company and the stock price shows like that, you're a very happy investor, right? So whenever you see this kind of trends, you wonder how far they can go, right? Do you think that the industry will keep increasing? What's your expectation?
I think it can.
It can.
I do think the issue is the dry powder.
Is the dry powder. Okay. 2.6 trillion, do you think it's a lot of money? How many people, raise your hand, how many people think that 2.6 trillion is way too much for private equity funds? Randomly, I mean, I know we don't have too much background here, but what is your sense, just the intuition? Yeah? Raise your hand if you think 2.6 trillion is a lot of money. Okay, so I presume that the rest believe that 2.6 trillion is not a lot of money, right? Okay, so it's very important to have some sort of benchmark. We need a benchmark to understand whether 2.6 trillion is high or low. And my favorite benchmark is an asset manager based in the US called BlackRock. Have you heard of BlackRock? BlackRock is an asset manager that invests in public equity markets. And do you know how much capital BlackRock, one asset manager in the public equity markets, has? How much capital under management? You heard about BlackRock. Did you hear? It's the largest asset manager in the world investing in public markets. They, at the moment, have under management 5.2 trillion. So one asset manager in the public markets is almost double the size of the global private equity industry. The hundreds and thousands of private equity funds that you see out there are now half of what BlackRock is managing in public markets. And BlackRock has a lot of exchange-traded funds. They buy a lot of indices. Most likely, your pension, your savings, somehow end up in some BlackRock account sent by your pension fund. So if you take BlackRock as a benchmark, then you might think that the industry is actually not that big, right? And I will show you some data as well on the performance of the industry. Given that the main investors in this type of vehicles are the pension funds, and given that the pension funds are facing at the moment a very low return environment, very low yield environment if you want, they're all trying to allocate more and more capital to higher yielding assets. And private equity is one of them. It's an alternative asset that is producing pretty good returns. And the average long-term returns, net returns, produced by private equity, according to the data, is somewhere around 14%. Right? So if you're a pension fund manager, you want to gain 14% per annum for the next 10 years by putting money in a private equity fund, or you want to buy a government security that will give you at the moment how much per year, you think, in the US? It's not zero, but it's actually less than 2%. So if you buy a treasury bill with a 10-year maturity, yeah, it will give you about 2% per annum, which is very little compared to what private equity could give you. So that means the expectation is that a lot of pension funds will keep allocating to private equity and in fact increase their allocations to the private equity industry because at the moment it's still generating much higher returns than one would see in the public markets or debt fixed income markets, government debt or corporate debt. Yeah?
Florin, sorry, can I ask a question? What about the crisis, the economic crisis? We saw that, for example, 2008 and 2009, there was a dramatic change in private equity capital.
Yeah.
So do you think that this 2.6 trillion US dollars is going to then go down or is going to increase? What's your
my expectation is that it will double or triple.
in the next 5 years?
In the next 5 years, double or triple again, just because there is so much demand for higher yielding assets. Now, the numbers that I'm showing you here, this 2.6 trillion, is actually an understatement of the assets under management by private equity firms. Because since the credit crisis, private equity firms have come up with a new product on the market called the private debt fund. So the money that I'm showing you here, 2.6 trillion, is money that is used to buy equity in private companies. But on top of this, you have private equity firms that manage private debt funds. Instead of providing equity to private companies, now they provide debt instruments to private companies. In the process, replacing the banks. And this is evolution as a result of the credit crisis, because the banks have been pulling back from lending, especially to risky private companies that are not rated, and that involves a lot of penalty on their capital. As a result, private equity firms started raising these private debt funds to lend to these companies that they understand very well because they invest in their equity. Yeah? So if you take the private debt on top of this, if you take some other strategies that are managed by private equity firms, such as private equity real estate, private equity infrastructure, and natural resources, also through private equity fund structures managed, then the total capital is getting closer to 5 trillion. And again, the private debt element has been growing even faster than what I'm showing you here. So there is still a lot of interest in private equity funds or private debt funds managed by private equity firms. Yeah? Yes?
Doesn't it go hand in hand, the growth of essentially high-yielding private equity and low-yielding fixed income growth? Because as the private equity business model relies so much on the debt
On leverage, yeah.
that side of things, you're on the total
Yeah.
return on
So certainly,
total return on capital. Does it change?
that's
a lot?
absolutely the case. So if debt is very cheap in the markets, as you mentioned, private equity funds, when they buy companies, very often, especially in developed markets, not in emerging markets, but in developed markets like US, UK, Europe, they will be using debt to acquire those companies. So imagine that I'm running a fund and I buy a company for $100. I will take $50 from the fund to buy the company, and the other $50 I'll borrow it from a bank or from the capital market to help me pay for the acquisition price. And if the debt in the market is cheap, then I'm more likely to take that debt and I'm more likely to acquire more companies because I have more capital. You know, I have more firepower, if you want. But that's absolutely the case. Now, before the credit crisis, the debt levels in a deal used to be 75, 80%. So I buy a $100 company, I put $20 from my fund, the other $80 is coming from a set of banks. Today, in today's market, the banks are not willing to lend as they used to anymore. Either they don't lend at all, in which case they are replaced by these private debt funds that also provide funding for private equity deals like that. Or if they lend, they will not provide more than 50%, typically 50-50, so that they have some buffer in case the deal doesn't work out. But so certainly, because there's so much liquidity in the market, when debt capital is available, obviously private equity funds have more of that to buy companies, which is not different than the real estate market, right? I mean, imagine that you buy a house in the US and the lenders in the US come to you and they give you loans without you putting any equity to buy the house, right? What do you do if you are a consumer that are offered this product? You just buy houses, right? Because you have zero risk. That's how you end up with a real estate crisis, right? When the banks lend too much, obviously you end up using that debt. The debt is cheap. Then you don't care about the price of the asset that you are buying, and you build a crisis. But certainly, the market, if you look at there are lots of indicators about the healthiness of these private equity deals that we see today, and the levels of debt today are significantly lower than what we used to see. Plus, private equity deals in emerging markets do not use debt, because banks in emerging markets do not understand these transactions, and they are actually more conservative than the banks here. So this is the trend, and expect this to keep going up. And you know, if you think about it, in any economy, the value of private companies versus the value of public companies is typically quite tilted towards private companies, right? If you take UK, for instance, if you look at the value of all private equity companies here in the UK, and you compare that with the value of all publicly listed companies here in the UK, you'll end up with a share of 70% to private, 30% to public. If you go to countries like China or India, the percentages are even worse, where private companies make up sometimes 95% of the value, and the rest is publicly listed. The point that I'm trying to make is that most of the companies out there are actually not publicly listed. And those private companies out there need capital. Who's providing capital for these private companies? Well, the number one provider is the banking system, right? Banks are supposed to lend to these private companies, but because of the credit crisis, because of the recent banking regulations, banks have been pulling back on lending to these companies, and that void is filled, that funding gap is now filled by private equity funds that have been going up. Yeah? And to be very clear, private equity funds are not regulated. So these are not instruments that are regulated in terms of disclosures, you and me, as retail investors, will not be able to invest in these funds. They are only addressed to institutional investors, and those investors typically are pension funds. Yeah? So, how many of you are familiar with the way a private equity fund works? Raise your hand. You're not familiar at all, okay? So, given that we talked a lot about private equity funds, let me just show you how it works. Basically, you have a private equity firm. This is the private equity firm here. You might have heard of some private equity firms out there, such as Carlyle, KKR. Have you heard of KKR? Blackstone. They are very large. For instance, what surprises a lot of people, I often ask in my class, who are the largest employers in the world? The largest employers in the world in terms of employees, companies. Any guesses?
It's KKR.
Or KKR. So the largest employer in the world is actually Walmart. They have 2 million employees. Yeah. The second largest employer in the world is a company called Foxconn that makes the iPhones and the Apple products and so on. They have 1.1 million employees. It's a Taiwanese company. It's lots of operations in China. But number 3 employer in the world, surprisingly, to 99.9% of my students, is actually KKR, which is a private equity firm that few people have heard of. They have 1 million employees. Why? Because their funds have been buying a lot of very large companies, right? So when a fund controls a company, the fund is controlled by KKR. Of course, KKR is responsible for these 1 million people. Yeah? Carlyle is the same, close to 1 million employees. Blackstone, very similar, about 800,000 employees. So private equity firms have become actually quite large, and they're quite under the radar screen. So the way it works, you have a private equity firm, such as KKR, and KKR, at a frequency of 3 or 4 years, will be raising a private equity fund, which is a new entity. You think of the private equity fund as being a new company, a new investment vehicle. This entity is created with the purpose of buying private companies here. Yeah? Is that clear? The capital that comes to this entity is provided in a proportion, on average, of 2% by KKR, or to be more specific, the employees of KKR, the private equity professionals from KKR, put their own personal money into the fund, about 2%, and the rest of 98% in the fund, on average, is coming from these types of investors: pension funds, sovereign wealth funds, endowment funds, family offices, you name it. Yeah? But typically, as you can see, the common denominator for all these investors is that they're institutional, sophisticated, high wealth investors. This is not for the retail market. Yeah? The reason why this is not for retail investors is because nobody in private equity wants regulation. The moment you get retail money, you'll be regulated by financial authorities all over the world, right? And you don't want that because private equity is meant to remain private. A lot of these private equity firms have investment strategies that are quite unique, and they have skills that are quite unique, and they don't want to make those skills publicly available to everybody. Yeah? Now, this entity, this investment vehicle, has a limited shelf life of 10 years. So we create an investment vehicle with a life of 10 years, with a single purpose of buying companies, holding them for a period of 4, 5, 6 years, yeah? And then selling them by the time the fund needs to be liquidated. So we are supposed to liquidate the fund in year 10. In practice, it doesn't really happen like that. Maybe the fund, on average, a buyout fund will be having maybe about 12, 15 companies in its portfolio. And a buyout fund can be as large as, 25 billion. This is the latest private equity fund raised by Apollo Capital. I don't know if you heard about this private equity firm, Apollo. They raised the largest fund this year. It can be as small as $100 million. Of course, the very large billion-dollar funds will be buying very large private companies. and sometimes even buy publicly listed companies and delist them. That happens quite often. If you live in the UK, probably you know, have you heard of Boots? It's owned by KKR. It's a 12 billion deal that was bought by KKR a couple of years ago. They're running it very well, and very soon you'll be seeing an exit, which probably will take place through an IPO. So these funds buy on average 12, 15 companies in the portfolio. They run them. By year 10, they need to sell most of them. But sometimes it's not possible. They might have one or two left. In that situation, the investors, together with the manager, agree to extend the life of the fund. And that usually happens in increments of 2 years. So every 2 years they meet, okay, we still have a company in the portfolio. Let's extend the life of the fund by another 2 years until the company gets to a better level, or we can get more money for this company, right? But most of the funds return the money back to investors before year 10 with some returns. But in terms of actual liquidation of the funds, you might see that in 14 years or 15 years. Yes?
You talk about them not being regulated, but you're talking about quite finite milestones that seem to be under some kind of governance. Is that the case? Why is it at 10 years they have to unwind the fund and then look at it every 2 years? Is there something in the law that...
No. This is an agreement, or just an agreement between these investors and this manager. Some funds could be, especially funds in China. At the beginning, the private equity industry in China, when it started, the funds were only 5-year funds or 7-year funds. Now they also switched to the 10-year horizon, because 10 years is kind of enough to give the manager enough time to improve the operations of this business and then sell it. If it's too short, it's not really, the value creation is very difficult to justify, right? And if the fund is way too long, 20 years, let's say, then it's not clear whether these managers are doing anything for 20 years. The investors want to see some returns quicker, right? So there is a balance somewhere. The 10, people thought that 10 is actually not too long and not too short. There are some funds out there, ultra long dated funds, that have a 20-year maturity. They are very, very, very rare. It's because some of these investors here, in particular the sovereign wealth funds and the very large pension funds, they have very long investment horizons. They don't care about a 10-year horizon. They care about 20 years, 30 years. And they don't want the money back in 10 years, because when they get the money back, they have to reinvest it in a new private equity fund. And that's a process that takes time and money. Instead, they would rather have it in a fund for 20 years. But those 20-year funds are very, very rare. Yeah? All clear? Yes?
Just a question in terms of the PE funds. You talk about segments of time, 2 years, 5 years, 10 years, 15 years, etc., right? So if, for example, a private equity firm invests in a company A, say $1 billion US dollars, in a segment of time, some will look for 2 years of return investments, some will look for 5-year investments, some for 10 years investments, and so forth. What is the rate of return in these time segments that they would be looking for?
Okay, this is a very good question. So let me explain how it works. First of all, given the 10-year life of the fund in the first 4 years has a 4-5-year period to invest the money. So investors will be committing, imagine that we are investors in a fund, we will be committing money to this fund. When I commit my money to this fund, it's not like I give them the money yet. No, I have made a commitment, a legal document. I write that if you need my money, I'll give you the money. Now, these fund managers, once they get these commitments, they don't get the money yet. They get the commitments from investors. Once they get these commitments, they go out there and they try to find targets. When they find a company, like a $1 billion company, then they call us. Within 10 days, you need to give me the money because I found a deal. They have 4 years or 5 years to do that. If in 5 years they don't find these investment opportunities, they lose the money. They lose the commitments. So obviously there is pressure to invest the money, otherwise you lose it. Yeah? So the first 4 or 5 years, the fund is investing. The next 4, 5, 6 years, the fund, or the fund manager, to be more specific, is running these companies, right? and then they're supposed to exit them. Now here's the trick, and this is the uniqueness of the private equity investment model. These investors that commit 98% of the capital to the fund, while committing the money, they also entirely give up their decision rights with respect to how this money is invested. Entirely. And on top of that, the money is locked for 10 years. That means you can't pull the money out. This is a closed-end fund. When the fund is in year 3 or year 4, if you as an outsider want to put money into the fund, it's not possible. The fund is closed. The fund was raised, was committed in year 1. If you didn't commit at that point, you can't get into the fund right now. Yeah? It's a closed vehicle. What do I mean by giving up decision rights? The only thing that these investors decide is how much money to put in the fund. Once they committed the money to the fund, at that point, from that point, the fund manager or the fund advisor, also called the general partner in this particular equation, has full authority on how the money is invested, when the money is invested, how to run those companies, and when to exit those companies. Yeah? So imagine that these investors outsource the investment process to these people. I give you the money, commit the money. For 10 years, I have no control over my money. And hopefully, people that got my money are people with reputation. And of course, I need to check on them. Who are they? Who are these people that take my money? They need to have the skills that I expect them to have to invest my money. They need to have the reputation. They need to have the integrity and the transparency that I expect from a professional fund manager. But otherwise, they will decide on how my money is run, and I cannot tell them when to give me the money back. They have 10 years to do so. Until year 10, I can't call my money back. So, to answer your question, I think that was your question, if these investors have different investment horizons, one wants the money in 3 years, another one wants the money in 7 years, too bad, the manager decides when everybody gets the money. And everybody gets the money at the same time on a pro rata basis. So if you put $30 in the fund and I put $20 in the fund, the manager has an exit. Yeah? They will be splitting this money that is exited, distributed to us, 30-20. You get your share, which is 30% of the fund. I get a 20%, and the rest get the remaining 50%. Yeah? Is that all? Now, of course, the managers get some fees to do this. And I'll not get into the fees because it's a very complicated fee structure. But suffice to say that these managers are paid a fixed fee, which is a function of the size of the fund. We call that a management fee. On average, 2%. So if we have a $1 billion fund, the fee of 2% comes to how much? 20 million per year. And this fee of 2% on average is paid for the 10 year of the fund. Yeah, so every year, the manager is getting 20 million in fees to run this fund. On top of this management fee, which is independent of the performance of the fund, the manager gets a so-called performance fee. That means the better the fund does, the more money the manager gets, right? That performance fee is called carried interest. And in private equity, on average, that is 20% of the profits. So if I have a $100 fund, and this $100 fund in 10 years goes up in value to 300, so it generated a profit of 200, the manager will be getting 20% of 200.
Is there a hurdle rate?
Some funds also have hurdle rates, especially in developed markets, and that hurdle rate is typically 8%. That means before I get my share of the profits of 20%, I need to pay investors 8% per annum on top of their capital, right? So I put $100 in the fund. I need to get 8% on that $100. After I get the 8%, then the manager can get the share of the profits. Now, as you can imagine, these fund terms are highly negotiable, right? And the fund terms differ from one investor to another in the same fund, right? If I'm a large investor and I give you 50% of the capital in the fund, of course I'll be negotiating lower fees for me. I'll not be paying 2% on my capital. Maybe I'll be paying 1.5% management fee. And maybe the carried interest might not be 20%, I might negotiate it down a bit. Somebody else investing in the same fund, smaller investor than me, might be getting worse terms. So the fund fees and terms differ from one investor to the other that are in the same fund. Yeah? Now, these funds, private equity funds, have different investment strategies. I kind of mentioned the buyout funds. The buyout funds are the KKRs, the Carlyle and Blackstone. What they do, a buyout fund typically acquires a company, acquires the control of the company. And when they buy these companies, they also use leverage from a bank, like I mentioned earlier. And this is the biggest chunk of the private equity market. I would say about 60%, 70%, yeah, more or less. There's another strategy that private equity funds follow, and that strategy is not to invest in mature companies and take control like the buyout funds, but instead invest in young companies with minority stakes. Not controlling stakes, minority stakes, and without any leverage. Those funds are called venture capital funds. They invest in startups, technology companies, you've heard about them. A lot of people talk about them, right? And that's another 10 or so % of the market. So venture funds are actually quite small compared to the buyout funds, yeah? Or you might have growth funds, right? A growth fund invests in a mature company, takes a minority stake in that company, typically 20, 30%, and the capital that they put into that company is used to grow the company to the next level, yeah? So it's not buying investors out. All the capital stays in the company, helps grow the company. You see a lot of growth funds in emerging markets. Yeah? And you can have also a private debt fund that works under the same principles. So instead of providing equity to these companies, provides debt. It will be a private debt fund. And the fee structure might be different a bit. Maybe the management fee is not 2%, it's only 1%, and maybe the carry interest or the performance fee is not 20%, might be 15% or 10%, depending on how you negotiate. Yeah? Is that all clear? So very recently in this market, just to close my discussion here, investors started to co-invest with the private equity funds. So they invest in private equity firms, but outside the funds. So if I'm a very large pension fund, Canadian pension fund, and I invest in a KKR fund, I give them $200 million to invest. KKR fund's a large company. They can say, okay, do you want to invest in this company also in addition to your commitment to the fund? This is called a co-investment, right? So I can put another $100 million but straight into the company without going through the fund. The advantage of co-investments, this 100 million, is that on that 100 million here, I will not be paying any fees. They source the deal, they execute the deal, they run the company, all that, but on my amount that is co-invested, I don't pay any fees. So overall, they manage 300 million of my money, but I pay fees on only 200 million. So that's a way for managers to incentivize investors to give them money in the fund by promising these co-investment opportunities. And they usually come when the deals are maybe larger than what the fund can handle, right? And the funds have some risk management approaches to investment. For instance, you cannot put more than 10% of a fund into one company. You need some diversification within the fund, right? And if that investment requires more than 10% of the capital, then you make up the difference by asking investors to co-invest with the fund. Yeah? Hope I'm not getting too technical here. Let me know if I'm going too fast. So co-investments are a very big development just because they have fewer fees, but also it allows these investors here to work together with a private equity firm and see how they operate internally. Because otherwise you wouldn't know how they do it, right? And maybe next time they raise a fund, given that you have worked with them on these investments, you'll be more informed when it comes to allocating your capital to this particular manager, right? Because there are good managers and bad managers out there. Yeah? So that's the private equity fund. Now, let me switch a bit the gears here and talk about corporate acquisitions. As I mentioned earlier, we have private equity funds buying companies. At the same time, we have corporates buying companies. And these two compete in the M&A market. Yeah? And they have very different approaches to investment that I would like to touch on a little bit. Now, if you look at the data overall, corporate acquirers, the very large companies that acquire other companies, on average, have been quite unsuccessful. So most of the M&A transactions initiated by corporates actually lose money. I don't know if you are aware of that or not, but unfortunately that is the case. But of course this is an average that hides a lot of things. And there are some companies that are very good at acquiring other companies, and there are some companies that are actually quite bad. And what does the data tell us? The data tells us that corporate acquisitions tend to be very, very successful when they meet this criteria. In other words, is this corporate a serial acquirer? If yes, that means they have developed some expertise in the M&A market, and that will predict more success, M&A success. Yeah? Is this corporate acquirer acquiring another company in the same industry? If the answer is yes, then it is more likely that deal will be a success. Because if I acquire in the same business, in the same industry, then probably I understand that industry very well. And on top of that, as a corporate acquirer, I'm better able to extract synergies with my target. Because that's an element of value creation in M&A deals, right? Another indicator of success in the corporate M&A market is whether these corporates acquire private companies versus public companies. The private company acquisitions tend to be more successful than the acquisitions of public companies. Why? Why do you think that's the case?
This is where the buyer is
The buyer is a corporate. The buyer is a corporate.
Yeah.
So who are the corporates that are successful? Those that are serial acquirers. That means they have an M&A team that does this over and over again. So obviously they build some expertise. Those that invest in the same industry as they are, the industry they operate. Those that invest in private companies. Why do you think investing in private companies brings more success than investing in another public company?
It's less complex. It can be less complex.
Can be less complex. What other thoughts you might have?
Does the market put a discount to private companies?
That's exactly the case, right? The publicly listed companies tend to trade at much higher multiples. They're more expensive than private companies. Private companies are a bit more opaque. They're illiquid assets. So you don't have as many buyers as you might have in the public market, right? Other reasons? Maybe private companies, for instance, are not as professionally managed as publicly listed companies, right? A lot of private companies are managed by their founder owners that sometimes start from very little and all of a sudden they end up managing a very large company. They don't always have the skills to manage a big company, even though that company is private. And when you acquire a private company, there's more scope to generate value by professionalizing the internal processes. Yeah. Corporates that are very active in emerging markets tend to be more successful if they acquire emerging markets targets. Why do you think that's the case?
Higher growth.
Growth rates. Usually emerging markets have very high growth rates. And many corporates see the entrance in emerging market as basically a way of building a channel to distribute their own products, right? I'm a European, UK-based company, for instance. I acquire a company in India. Yes, I want to maybe have access to their products, what they make in India, but also I'll use this opportunity to distribute the products that I make here into India, because now I have this Indian operation that will help me better access that market. It gives me the expertise in that market. And finally, the more successful corporate acquisitions are those that invest early in the growth cycle, right? If you look at the media and you see that everybody is doing M&A, if you see that the M&A deal flow is at the peak level, probably you are very late to the party, right? That means when you start buying at that peak of the bubble, you probably overpay for targets, and probably you don't get the right targets anyway, because those are the ones left. It's like going to a party, right? If you show up late to the party, you eat whatever is left on the table, right? And you drink whatever is left in the glass, in the bottles, right? So you don't get necessarily the best choices. So this based on data. I mean, I'm showing you these statements here, but there's a lot of data, there's a lot of analysis that people try to understand what are the success factors in this market. Yeah. Now, so here's the background, right? I kind of told you about how the private equity market has evolved a bit. I told you a bit about how a private equity fund is working. And I also told you a bit about the success factors in the corporate acquisition market. Now, this is research that I've done with my colleagues here at London Business School, in which we analyze a very large set of M&A transactions in Europe. Yeah? And the main purpose of this analysis, and we have a lot of tests, a lot of numbers, a lot of data. I'll not bore you with that. I'll show you just 2 graphs to give you the idea behind the whole research. But what we wanted to understand is whether private equity firms do a better job as acquirers than corporates. That's the basic idea, right? And we have evidence that private equity funds do better than the corporates. But what we don't know is how they do it. What is exactly under the hood? What is it exactly that private equity firms do to get these very successful deals in the M&A market? Yeah. So at the deal level, value is created through 3 channels. If you acquire a business, you can create value through 3 very basic channels. Let me explain one at a time. One is the leverage channel, right? Imagine that I buy this business, and can be a private equity fund, can be also corporate. Corporates also have access to leverage. And in fact, when corporates take leverage to acquire businesses, they have access to very cheap leverage, right? If you think about Apple or Microsoft, they can go and borrow in the market for very little rates. While if a private equity fund goes to borrow, the interest rates would be much higher, as you can imagine, right? Now imagine that you buy a company for $100, just for the sake of the example, and you put down 20 in equity. The other 80 comes as debt from a bank. Are you still with me? Yeah? That's the only thing you do. You sell this company 5 years later, also for $100. Still with me, yeah? And I can still make a significant return on this deal. I buy it for $100 and sell it for $100. But the only thing that I do between buying and selling is to pay down the debt. That's the only thing I do. Nothing else. I don't increase the EBITDA of the business. I don't increase its operations. I sell it at the same price at the end of the day, right? So if I start with 80 in leverage at the beginning, so I put 20 equity, and when I sell it, the ratio flips. Yeah, I have 20 in debt by the time I sell. Now equity is 80. Well, my investment grew from 20, which is my initial equity ticket in the deal, to 80. I made 4 times my money by simply servicing the debt that I took to buy the company. That's what we call the leverage channel. Are you comfortable with that? Of course, it only works for companies that can service the debt. You will never buy a company that doesn't generate free cash flows that will allow you to pay down the debt. Otherwise, you'll default on that debt. And when you default on the debt, what happens? you wiped out and the company is taken over by lenders, right? You lose the business. Yeah? So that's the leverage channel. There is an operational channel at work as well. Let's assume that I buy this company for $100, no leverage. Yeah? And I buy this company at 10 times the EBITDA. And EBITDA is 10 as well, right? 10 times 10 equals 100. Are you still with me? A lot of businesses in the M&A market, their value is quoted as a multiple of EBITDA. It's very, very common in this market, right? So this business is trading at 10 times the EBITDA, right? And when I sell it, I also sell it at 10 times the EBITDA. The only thing that I do between buying and selling in this particular channel is to increase the EBITDA, right? So I buy it at 10 times the EBITDA. EBITDA is 10. When I sell it at 10 times the EBITDA. But if the EBITDA is 15, I sell it for 150 now. So I made a return of 50 on this particular deal. Yeah? That's the operational channel. The valuation multiple channel is the other one. I buy the business at 10 times the EBITDA. EBITDA is 10. But when I sell the business 5 years later, EBITDA is still 10. But the multiple is not 10 anymore. Could be 15 or 20. Yeah? And it might be a situation where I'm a very good screener of deals. I'm very good at sourcing these deals. I get a company that is undervalued. I buy it at 10 times the EBITDA today. And I sell it at 15 times the EBITDA 3 years later. And that's my skill, right? So these are the three channels. And of course, these channels interact, right? So if I put leverage, if I improve the EBITDA, and also find an undervalued asset, you can see that I make value through all these three channels. And my equity returns on this deal is obviously much higher. So this is the background behind our analysis, right? Because now I'm showing you some numbers. So that means that you create value in a deal if you are able to buy cheap, if you are able to increase the EBITDA, and if you are able to put a lot of debt that could be serviced by the deal. Yeah? Is that okay? So here's some data, right? So we take all these deals in Europe that are initiated by private equity funds, and then we also take all the deals that are initiated by corporates. On top of that, as a benchmark, we also look at private companies that don't change their ownership as another benchmark, right? So here's what we find. Initially, we look at the extent or the EBITDA multiple that these acquirers pay for the targets, right? And what you see with the red line here are the EBITDA multiples paid by corporate acquirers. And with the green line, you see the EBITDA multiples paid by private equity funds. Yeah? Now, very simple graph. There's a lot of analysis behind it, but what this graph is showing you is that most of the time, when private equity funds acquire businesses, they pay less than the corporate acquirers. Yeah?
I think what the graph actually shows is they're converging over time. Can you comment on why that's the case?
Oh, they are converging because obviously the market is becoming a bit more competitive. There are a lot more private equity funds out there. So the industry used to be small, now the industry is significantly bigger. So there's a lot of competition for deals, yeah? And also, to one extent, one reason why there is convergence is that also corporate acquirers have been learning from private equity funds. So corporate acquirers also started to use leverage. Oh my God, we have this nice company. Why are we using our cash flows? Why don't we go to a bank and borrow from a bank at 2% or 3% and use this money to acquire this target? Yeah? So of course, it's a reflection of the fact that the market is becoming more competitive. But regardless, on average, what we see that they pay less. Yeah? And of course, the last year here, they are kind of equal. There's no significant difference between the two. But on average, you can see that private equity funds are able to pay less. And I'll explain why.
Would you say the same for the recent years?
for the recent years is about the same. So I don't have the latest data, but continuously private equity funds are paying less than the corporates.
There is not a reversing trend.
Yeah, so the green line drops again a bit. Yeah, I don't have the latest data now, and I'll tell you why. There is a rational explanation for this. First of all, one might argue the reason why corporates pay more than the private equity funds is because corporates, when they acquire a target, they also get, what do they get when they acquire a target? Synergies. While the private equity funds, they don't get those synergies, right? Because they continue to manage these companies independently, right? See, those companies that you saw here, they're independently run with their own management. They don't change anything, right? While when a corporate acquires a target, they typically would want to integrate it, right? And that means some cost savings. And because of these cost savings, they might be willing to pay more for the target. That's one explanation, yeah? It's not the main one, actually. And I'll give you another explanation once we go through all these graphs. So here's the first finding. The private equity funds are paying less. The second finding, significant finding that we have in this paper is that once they acquire these businesses, the private equity owners are significantly better owners. There is a better corporate governance mechanism because it seems that once they acquire the targets, private equity owners, which is this light blue line, are able to increase the sales much faster than the corporate acquirers, which is the dark line. They're able to increase EBITDA much faster. They're investing in more assets, and in particular, more fixed assets. Yeah? So you can see that on the operational side, not just the purchase side, buying cheap, private equity guys are actually more aggressive. They run these companies better, yeah, based on this data. Yeah.
Isn't it relatively difficult to find the performance post-merger from corporates who integrate the operations of acquisition into their own? So it's hard to...
That's why we look at the European companies, because they are separate legal entities. Even though they are owned by a large corporate, they are separate legal entities, continue to be separate legal entities, and they continue to report their financial statements to European regulators. And we are able to observe the financial statements of these private companies owned by corporates. So you'd think that if there are synergies in the large corporate, then the EBITDA growth should be much faster for the corporate deals. Wouldn't you think so, right? Because they're able to save more.
Must be also an element of short-term and long-term perspective. So clearly, private equity would look at squeezing as much as they can in the first 3, 4, 5 years, whereas a corporate would integrate a target into their operations and run it for the long term.
Most of the integration processes, if you look at any M&A deal, should be finished within 3 years. So the integration should be at most 3 years. We looked at up to 3 years of data here, right? And still after 3 years, they're not able to do it as well as the private equity guys. And I have some explanations for that, but for now, I'm just showing you the facts. And I'll try to rationalize, interpret these facts a bit later, why the private equity owners are somehow better owners of companies than the public owners. And there are many, many reasons on the operational side that I will show you in a moment. But for now, suffice to say that the average 3-year growth, right? And this is the average, what you would see integration period of any corporate deal. It is significantly superior for private equity funds. Yeah. Why? Why are private equity funds better at running companies, or private equity firms better at running companies than public owners or corporates? Yeah. And this is actually a very serious question. A lot of high-level executives are trying to understand what they do wrong and what the private equity guys are doing better. I'll give you some data here. Now, here is the data on the performance of private equity funds versus publicly listed companies. Okay? Just to show you that in aggregate, indeed, private equity funds generate better returns than publicly listed companies. So if you can see over a period of 10 years, in the United States, yeah, if you compare the average private equity fund in the United States to the average company in the S&P 500, which is the largest index in the United States, over a 10-year period, a private equity fund, average fund, is generating a return of 11%, while the publicly listed company in the US only 8%. If you increase the horizon to 20 years, private equity does 12% per annum and 7% for public equity. This difference of 500 basis points is actually huge. And this has been shown over and over and over again, study after study, and it's not in the US only. You see the gap also in Europe. Public equity in Europe doesn't do as good as in the US, but private equity versus public equity, the gap is very large. 700 basis points. Here you have, 10%, which is 1,000 basis points. That's a lot of difference, right? So it must be that these private equity funds are doing something better than the corporates. And of course, you've seen how they grow the operations. You've seen that they pay less. Yeah? Here's the same in Asia Pacific. Here's what I think are I have 5 minutes, right? Here's what I think are the 6 advantages of private equity over public equity that explain the results that I just showed you. Yeah? First of all, private equity is about active investing, right? That means, as an investor in a private equity fund, when I give you the money, I'm not expecting you to just buy a company and then wait to see what happens. No, I expect you to be involved in that. I expect you to sit on the board of that company. I expect you to change the management of that company if the management is not performing. I expect you to be actively involved, right? So it's not luck here. You need to really actually run that company. You need to be involved. Yeah? A lot of investors in public equity are not actually active investors. That's a big difference. I mean, think about it. How many investors of a publicly listed company actually bother to vote in a board? First of all, most of them are not represented in the board. If you have retail investors like you and me and we buy shares in a publicly listed company, we are passive investors. We have no say on how that company is run. If that CEO of the company decides to buy a private plane, we'll not be able to say anything, really. We are too small. In private equity, it's not possible. It's one owner of the business. You can't do that. We own the business. You can't waste the money like that, right? On average, about 30%, sometimes 40% of the shares of a publicly listed company are owned by index funds. You know what an index fund is? In your pension, when you save for your pension, all consultants will tell you buy the index, buy the S&P 500 index. So they create these index funds that buy the index. So they buy the shares in these companies, but they are silent shareholders. They will never vote in a board meeting. They will never attend a board meeting. Yeah? If you look at Fidelity, that is running a lot of mutual funds, a lot of index funds, they sit on 0 boards of public companies. 0. If you look at KKR, how many boards they sit in the companies in their funds? 100%. That means active investing. I'm there to check on the management. I'm the main shareholder, and if the management is not performing, I'll fire them very quickly. Yeah? The board meetings in private equity take place monthly. Yeah? And when they have a board meeting, they'll be talking about how to run the company. When you have a board meeting in the public markets, usually it's quarterly, and it's not about how you run the company, it's about what do we disclose to the market so that we don't get sued. That's usually the concern in a board. I don't know if you attended any board meetings, but that's the experience that I had. Private equity funds invest in companies with concentrated ownership. When you have 3 people sitting at the table, 3 shareholders, concentrated ownership means that you make decisions very fast. You have 3 people, we are all grown-ups, we understand how to make decisions for the benefit of this company in the long term. When you have thousands of shareholders, when the ownership is dispersed, these people will never agree on how to run a company, And that's why the management gets away with anything, right? Number 3, there is better incentive alignment in private equity. And I think this is the most powerful one, okay? In private equity, we buy a company, we put $100 in the company, and we get paid the 20% of the profits once those profits are realized in the deal. That means until I sell the business with a profit, I don't make any money. I get the management fee, but that management fee really of 2% or 1.5% just covers my costs, my due diligence, my operations, my office and flights, whatever, right? In private equity, I'm driven by that 20% of the profits. And here's the interesting element. A private equity fund manager gets the profits, the 20%, only after the investors in the fund get paid. They get their money back and they get their other 80% of the profits. Until then, I don't get paid. While in public equity, it's not the same. Public equity, if you're the CEO of a business, you get your shares, they vest, you sell the shares in the market, you get your money. Doesn't matter that you have an investor in your business with a 10-year horizon that wants to hold the shares for 10 years. You don't care. Once you get the money, you can retire. Not in private equity. You can get the money before the investors get the money. It's an important element. Plus, on top of this, in private equity, the CEO of a target company that sits here gets a lot of sweat equity, typically 10, 15%, the management team. In a publicly listed company, the executive team usually owns less than 1%. Yeah.
I'm just interested in the personal returns to the fund manager versus the CEO, the acquiree. So obviously the fund manager has a portfolio that sort of reduces risk.
12, 15 companies,
yeah.
yeah.
Has more risk. Who's making more money typically, the private equity fund manager or the CEO of the acquiree?
It depends a lot on the deal, but the CEO of the portfolio company can sometimes make more money because they get 10, 15% of the equity of that portfolio company. That portfolio company is very, very successful. They can make excellent money, right? Or they can make no money. But you see, that's the problem in private equity, right? If you're the CEO of a business and you know that all your money comes at the end of this 6-7 year period, and you have no diversification, you basically have to work very hard because either you make a lot of money or you get zero. So the cost is very high, right?
And they get fired.
Or you can get fired. You don't even reach year 6, right? You'll be fired in 2 years. And whatever shares you got in the private company will be taken from you because the vesting schedules are usually at exit. Yeah?
In order to start thinking about has PE and private equity succeeded, they have to have had the same aim in the first place. And for all those different reasons why the public equity might have taken place for access to brands, access to markets,
Yeah.
they're very, very different to the aim. The PE is always going to be looking at the profitability and the value
Yeah.
after 10 years. So they don't start off with the same aim. So how can we say private equity has succeeded?
Yeah. Well, when I say it's succeeded, I'm only talking from the perspective of value creation for shareholders.
Yeah. So
The returns in the share price, the returns that you provide to shareholders, in my view, this is the only way you measure success. Indeed, the CEOs of companies, of corporates, they will always say, well, we have acquired this business not because we want to make a return, but because we want to do this, we want to have access to technology. But at the end of the day, whatever you do, shouldn't that be reflected in shareholder value?
So if you could strip out of your figures on the corporate side all those companies that made acquisitions for other reasons, then you'd have a better data set to look at. And you might be able to see that actually they're not that too different.
So in my simple mind, my simple view is that whatever reason you have to acquire a company as a corporate, whatever justification you have, the ultimate objective is to create shareholder value. Now, you might argue, well, Florin, maybe shareholder value is not created in 3 years. Maybe it takes 10 years. I don't know.
Or it could be to protect, because if there's a rival in the market, you could be buying him out.
Could be. So there might be some opportunity cost hidden that I don't observe. But generally, right, I absolutely understand what you're saying, and I agree with you. Of course, in practice it's very difficult to observe these hidden reasons, right? So most of the people out there, the only benchmark they have is value creation for shareholders. Show me the returns that you generate to shareholders in the public market versus private markets. And of course, private and public will have their own reasons, but everything should be translated into what the shareholders get. Now, just to quickly finish off this, I probably am running out of time now. In private equity, there's a very large reputational cost as a manager. If you blow up a fund, if the fund doesn't do well, nobody will give you money ever again. Because in private equity, remember, as an investor, I don't have any control over my money. So I have to trust you with my money for 10 years. If I have evidence that in the past you messed up, I will not trust you for the next 10 years with the next fund. So it's either you have reputation on the market or you cannot raise a fund. While in public equity, the CEOs of publicly listed firms, reputation is not that painful. Because if you fail as a CEO of a publicly listed company, you can always get another CEO job at some other company, and all is forgotten, right? Private equity, the memory is very long. Fifth advantage, private equity is private. That means whatever we do stays with us. Nobody can see what we do. Nobody can see our strategy. Our competitors, so imagine that portfolio company here, its competitors cannot see their financial statements. So no proprietary information is released because it's sitting in a private equity fund. Those financial statements remain private. Yeah? And that's a big element, because if it's a publicly listed corporate, then of course you need to worry about. Plus on top of this, is a publicly listed, then you have to worry about regulations and disclosures and so on. Finally, why private equity is successful is because it's the only asset class, I would argue, where insiders make liquidity decisions for the shareholders. What do I mean by that? I mean, if I'm an investor in a private equity fund, I really don't know when the company is ready for sale. Who decides for me is the manager. Who is the manager is an insider who has been running this company for 4 or 5 years already. They know when to sell. And they'll try to maximize the value because they make a lot of money if they maximize value. And in process, I will make money, right? So when the insiders make the liquidity decisions for me, I'm actually better off. If I own the shares in a publicly listed company, I have the option of selling the shares anytime in the market. And as an investor, I know very little how the management thinks about the business. Right? So I might be making the wrong decisions. I might be selling my shares back in 2009 when the market was low, right? Instead of keeping the shares so that I get the uptick in the market. But the point is that in private equity, these managers know these businesses very well. And as insiders, they tend to make better decisions than outsiders, the investors. Yeah? So all this combined, as you can see, explains to some extent why private equity has been more successful so far than corporates in the acquisitions market. And of course, because they have a limited time span, I need to sell the business in 5-7 years, I really need to get to work very quickly. While in the corporate world, I acquire a target, I don't need to sell it. It's very hard to measure progress there. So I can slow down. I don't need to increase the sales as quickly. I don't need to push as hard, right? And also compensation agreements are very different.